Hello again, everyone. I'm Nate Keene, and welcome to the Mortgage Podcast. We've been fielding some questions here lately from callers who are asking about comments made here on a previous episode that irresponsible consumer spending played a major part in the foreclosure crisis. However, we keep hearing one recurring question, and that is, how much blame can be placed on the banks for this disaster? So today, we will address that question. Is it true that I've seen a lot of consumers who mishandle their finances with frivolous spending after they bought their home? It's true. In reality, furniture and big screen TV purchases along with major landscaping changes do not have to be done immediately after moving in. Nonetheless, I think banks have also played a huge role in this problem. Over the last several years, large banks hired mortgage loan officers to recruit clients with poor credit for 2-year adjustable debt consolidation loans. The borrowers with spotty credit would take cash out against their homes to fix their credit with the promise that their credit scores would increase, resulting in a better rate before the 2-year arm would adjust. But things did not go according to plan. As banks started to see more foreclosures, they took away the refinancing opportunity by continuing to raise the credit scores needed to get out of the loan. Here is a typical example. John Smith was called by a bank 2 years ago and took a 2-year debt consolidation arm at 8%, even though at the time he had a fixed at 6%. John's credit score was 520, and the loan officer told him that if he got up to 620, he would later be able to get a fixed at his original rate. John Smith did what he was supposed to do. He paid off his credit cards, and after the refinance, continued to pay all his debts in time, and over time, he raised his score to 620. But when he went back to his lender to refinance back to his original rate, the bank told him they won't refinance him because the new minimum credit score is 660. And when John Smith calls that lender's subprime office to get a non-prime loan, the phone just rings and rings because the bank closed down that department. So in answer to the listeners' questions, yes, direct lenders really played a huge role in creating this mess. And to dangle a teaser loan program like that only to pull the rug away just as the customer reaches the goal is like the NFL going to the Giants after the Super Bowl and telling them that there's a new rule and the champs now have to win 2 out of 3. For more mortgage information, feel free to give me a call at 800-991-9575. That's toll free, 800-991-9575. I'm extension 202. For the Mortgage Podcast, this is Nate Keene.